There it is, in the distance. That seemingly perfect stock you've been searching for, far and wide. It has a killer product offering, it has strong growth prospects, it even has a fantastic leadership team. There's just one problem. It's way, way, way out of your price range. So what do? Just let what you believe to be a great opportunity pass you by? Well, you don't have to, because there's a way you can take that leap of faith without ponying up all the cash or leaning heavily on margin up front. It's by using an appropriately named type of option called leaps. Intrigued? Then let's dig into the details. Leaps stand for long-term equity anticipation securities, and simply put, they are long-term options that work largely the same as standard options. In the case of calls, they provide the buyer the right to purchase an underlying stock at an agreed-upon price in the future. And in the case of puts, they provide the buyer the right to sell an underlying stock at a certain price. One contract typically allows the buyer to acquire 100 shares of the underlying, and it's usually much cheaper to purchase leaps than shares of the stock itself. But there's one key difference. Leaps expire at least 1 year from the time of purchase. Some even have expiration dates as much as 3 years away. This means the buyer has more time for the underlying stock to hopefully move in a favorable direction. Plus, leaps also lose value slower than standard option contracts, thanks to that longer runway. So, leaps essentially grant the holder exposure to the underlying for a longer period without the hefty upfront cost of buying the underlying outright. If the buyer wants to exercise the option down the line, they can cross that bridge when they get there. Or they can dish off the contract for a profit. Sounds like a pretty sweet deal, doesn't it? Well, like anything in life, there's no free lunch. There are some drawbacks to leaps. For one, they are pricier than shorter-term options. Essentially, you're paying up for that extra time. They also tend to be less sensitive to changes in volatility, which could be beneficial or detrimental to the buyer, depending on the circumstance. Leaps can be illiquid because of their wide spreads between the bid and ask prices, so this makes it tougher to make a quick buck by trading them. Leaps also miss out on some of the benefits that stockholders enjoy, such as dividend payouts. And of course, they do have expiration dates, and therefore can potentially become worthless. All that said, buying leaps can be a viable alternative to owning stock outright. For example, some traders will purchase leaps that are deep in the money with high delta. That means changes in the price of the option closely follow changes to the underlying stock price. The closer to the option's delta is to 1, the stronger that relationship is. And the closer it is to 0, the weaker that relationship. In this way, the leaps holder gets to largely mimic the movement of the stock without needing to buy it. Let's walk through an example to spell out how this works. In this instance, we'll ignore trading fees and commissions, but make sure you're aware of them when you trade in real life. Say two traders named Jack and Derek each like the prospects of a fictional stock we'll call ABC1 Corp. That's trading at $50 per share. Derek snaps up 100 shares for a total cost of $5,000. Jack, on the other hand, doesn't want to shell out that kind of cash. Instead, he buys one Leaps call on ABC1 Corp stock for $20. It carries a strike price of $40 and expires in 1 year's time. Jack's total cost is the premium of $20 multiplied by the 100 shares deliverable in the contract, which equals $2,000. Now let's say ABC1 Corp stock climbs to $100 within the year. If Derek sells his shares, he'll earn a $5,000 profit. That's the difference in the stock's price now and when he bought it, which is $50 multiplied by the number of shares he owns, which is 100. All in all, a 100% return for a doubling of his capital. Nicely done. But how did it go for Jack? Well, his Leaps call is worth about $65 since the stock appreciated so strongly during that year. So, if he sells his option, he'll earn a profit of $4,500. That's the $65 it's currently worth minus the $20 he initially paid for it, or $45 multiplied by the deliverable of 100 shares. That works out to a 125% return. Jack would have earned nearly as much profit as Derek did, even though he staked much less capital in the trade. The magic of leverage in action. What's more, if Jack was willing to commit $5,000, he would be able to afford more Leaps than he would shares of the underlying. And that would obviously make his profit much higher in our example scenario. Of course, the market isn't always smooth sailing. What would happen to our two traders if ABC One Corp shares tanked to, say, $10? Well, Derek would be out $4,000 if he decided to sell his shares. He'd be down $40 per share due to the stock's drop, multiplied by the 100 shares he owns. Of course, he could opt to hold them in hopes they bounce back. Jack, on the other hand, would lose the $2,000 he invested in the option. It would expire worthless since the stock is trading below the strike price of $40. But the silver lining is that's less than what he would have lost had he bought the underlying shares. So, you can see the appeal of leaps as a stock replacement strategy. Now, stock replacement is just one of the many strategies that options traders have at their disposal. Learn about another one in our lesson, Why Sell Covered Calls.